All right, we're going to go ahead and get started. Good afternoon. Welcome again to the Benefits Open Enrollment session. Thank you so much for being here. We have a full time today to go through this presentation and also answer many of your questions. We'll ask that you please submit questions via the Q&A feature on the webinar, and we'll make sure that we get to as many of those as possible throughout the presentation, and then we'll also hold some time at the end for questions as well. With that, I would like to turn it over to Kathleen, who will be leading our presentation, and Deborah will be monitoring our chat as well.
Thank you. My name is Kathleen. I'm a benefits counselor, and as Kelsey mentioned, Deborah is joining me to help with questions that come in through the Q&A while I'm presenting. So thank you all for coming. We have a big group, which is wonderful to see. This is our first presentation for open enrollment for plan year 2026. The open enrollment, as you know, begins on Monday, October 6th. And just as in previous years, it goes for 2 weeks and it ends on Friday, October 17th. And any changes you make during open enrollment will take effect on January 1, 2026. Just want to briefly point out, we have some new resources online that are really wonderful. They're quick, short videos, 2 or 3 minutes, on a variety of topics, from education benefits to primary care to leave for birth of a child. So please check those out. They're great resources and they don't take very long to watch. So one of the main questions we have every year is just, please tell me, what do I need to do? So one thing that we're asking you to do is review your options, review the benefits that you've had the past year, and think about, have they been working for you? Is there anything that you're thinking you might want to change? Is there anything you want to explore in terms of changing your benefits? So if you can start thinking about that now and doing a little research on our website, then you can be ready when open enrollment opens to just go in and do your election. We also ask that you have any documentation you're going to need ready to go, as you'll need to upload that when you do your open enrollment. What that is if you're adding a dependent to any of your plans, or if you already have a dependent on your plans, but you're adding them to something new, then you'll want to have documentation of their relationship to you. Meaning, for a child, a birth certificate. For a spouse, there's 2 documents, a marriage certificate and a copy of the first page of your most recent tax return that shows your spouse listed. So if you just want to maybe locate those, because I know sometimes those are not so easy to find. And then lastly, of course, when open enrollment opens, we want you to go into Workday, elect your benefits, and make sure you don't just save them for later, but that you review and sign and submit and keep a copy of your elections. Our other most popular question during open enrollment is, what happens if I don't do anything? Well, if you don't do anything, pretty much all of your benefits, with one exception, are going to roll over into 2026. There is one exception to that, which is the flexible spending account. If you have an FSA, you must go into open enrollment and elect that for next year. Otherwise, you will not have it for next year. And that is true whether you're signing up for an FSA for the first time or whether you've already had it this year. You still need to go in and elect it for next year. An FSA, by the way, is different than an HSA. So if you have an HSA, that is different, and that does roll over if you stay in the high deductible health plan. So I wanted to talk first about what's staying the same. The deductibles for the UVA PPO and the choice health options are staying the same. The out-of-pocket max is going to be same for the PPO and the choice health options. Preventative care is still going to be covered at 100% for all 3 plan options. That has been true for a long time. And copays and coinsurance are going to remain the same for all three health plan options. And we are keeping Aetna as our administrator. And so let's talk about, well, what is changing? So there are changes to premiums for this year, and we will have a separate slide on that. So we'll get into those details later. And then for our health savings option, which is our high deductible plan, we have some changes to deductibles and the out-of-pocket max. So the deductible is going to change to $3,000 for an individual, meaning if you have employee-only coverage, or $6,000 for family, meaning if you're adding anyone onto your plan. That is our in-network cost. The out-of-pocket max is also increasing somewhat. It's going up to $6,500 for an individual and $13,000 for a family for in-network. If you want to see more details, you can scan these QR codes and it'll take you right to our website. So since we're talking about the high deductible health savings option, let's jump right into that plan option. This again is our high deductible plan. And if you have employee only coverage, you're going to need to meet a deductible of $3,000 before the plan begins to pay. And when it does begin to pay, it pays at 80% and you pay 20% coinsurance. If you have anyone on your plan, so you have employee plus dependent, employee plus spouse, family, then your deductible is going to be $6,000. You will not have an individual deductible. And again, the out-of-pocket max is $6,500 or $13,000 for family. The prescription coverage is part of the deductible and coinsurance. So this is not any different than previous years, but I just like to remind people because sometimes the first thing you might need in January is a prescription. So remember, you're going to have to meet your deductible again in January. There are some exceptions to this, and that is if you have a medication that is on a specialized preventative medication list, then that will skip the deductible. Now, the health savings option is the one option that is eligible for something called a health savings account, or HSA. And those of you who already have it, you understand what I'm talking about. Others of you may have heard about it, but not really sure what it is. So a health savings account is an amazing vehicle for saving money pre-tax so that you can meet those larger out-of-pocket expenses, that larger deductible. So you can put money aside through payroll deduction, and that money has a triple tax advantage, meaning that the money that you put into the HSA is not going to be taxed. When you take it out for eligible health expenses, it is not taxed then either. And in addition to that, the triple part is that after you have more than $1,000 in your HSA, you can invest that money if you want to. And if that money grows through investments, that growth is also tax-free. So I don't know very many things in this world that don't get taxed. So that's one of the very appealing things about the health savings account. I do want to point out there are a few eligibility items that you need to be aware of. First of all, you can only have an HSA if you're on the high deductible plan. That's per IRS rules. And you don't want to be on TRICARE, Medicare, or Medicaid and have an HSA, or else you're going to run into a potential IRS penalty. Lastly, if you or your spouse have an FSA in the same year, you're going to run into issues. So if your spouse has a different plan or works at a different employer and they're thinking about getting an FSA, then you'll want to talk to make sure that one of you doesn't have an HSA while the other has an FSA, because that is going to run into some problems. So the other huge benefit of this HSA, besides the triple tax advantage, is that UVA contributes to this account on your behalf. So not only can you set aside money from your paycheck pre-tax, but UVA contributes seed funds into that account for you. So in mid to late January, if you're on a biweekly pay schedule, you're going to get $1,000 from UVA in your HSA if you have employee-only coverage. If you're covering any dependents on your plan, you're going to get $1,500 into your HSA from UVA. So that's to encourage you to start saving and to help you to start having some money set aside for that high deductible, because we don't want you to avoid going to the doctor if you do need to go, or we don't want you to avoid picking up that prescription that you need. Please keep in mind, if you are new to the HSA this year, you want to look for emails from Fidelity, because the HSA is like a bank account, and sometimes they ask for additional information in order to open the account. So they may reach out to verify some identifying information. You need to respond to them in order to get your account open and ready for funding. If it's not open and ready for funding within 90 days, then you will forfeit the employer contribution, and we definitely don't want that to happen. That's just for new enrollees who have not yet opened an HSA. So moving on to our second health plan option, and that is called the UVA PPO option. It used to be called value, but we're not using that term anymore. So the UVA PPO is more of a traditional structure where it has a smaller deductible than the other plan. It has an $800 individual deductible or $1,600 family. And then once you meet the deductible, your coinsurance is 20%, meaning you pay 20 and the plan pays 80, until you would hit the out-of-pocket max in case you have any large expenses. The UVA PPO has something that the other two options do not have, and that is copays for office visits. So if you go to visit your primary care provider or a specialist, you're going to pay a flat dollar copay for that office visit. You're going to pay 40 for primary care or 80 for specialist. If you go to a UVA provider, you get a discount on that copay, and so you would pay 25 or 50. Now that is just for the office visit. So if other things happen while you're there, like you get an x-ray or a blood test, then those items would be subject to the deductible and coinsurance. The prescription coverage, again, is rolled into the deductible. But unlike the high deductible plan, the UVA PPO option has a tiered coverage, meaning that if your prescription is a generic prescription, then it has a flat dollar copay, meaning that you pay the copay and it skips the deductible. If it's not generic, then it's going to be subject to the deductible and coinsurance as normal. Again, there are some specialized lists called the chronic medication list and the preventative medication list. So certain drugs may skip that deductible. So again, that's our second option, the UVA PPO. Lastly, we have the Choice Health option. And this is the last year that we're going to be presenting on this because it is closing on January 1st of 2026. So we won't have any new enrollees after that. It will just continue with the people who are already enrolled. So this is the last open enrollment where you can enroll in the Choice Health option. This has the lowest deductible of $500 for an individual or $1,000 for family, and you have a 15% coinsurance. The prescription coverage is exactly the same as the previous UVA PPO with the tiered coverage and the flat dollar copay for generic prescriptions. Now let's look at the premiums, which is going to be a big factor in your choice, I am sure. So you can see that the premiums are the lowest for the high deductible health plan. Because you have a higher deductible, that means you have lower premiums out of your paycheck. The UVA PPO falls in the middle, and the choice plan has the highest premiums. These are monthly premiums, so if you are paid biweekly, please divide this in half in terms of what you would expect on a regular paycheck. And you can go ahead and take a photo of this if you just want a snapshot. Obviously, this is on our website, but if you want a photo, that's kind of a good way to refer back to it. And in parentheses is where you see the increase in premiums from last year. This is another way of looking at the same information on one slide. So this is an employee-only coverage. And what you're looking at is in the orange is the amount of premiums that you're going to pay over the entire year. So at a quick glance, you can look at that orange and see, oh, okay, this is how much I'm paying during the whole year just to have the plan, regardless of whether I use it or not, or what services I use. So that's a fixed cost factor. Then the second thing you want to look at is the deductible, which is in the kind of light gray or light blue. And you can see the health savings deductible is higher than the other two. And then lastly is the out-of-pocket max, which represents the absolute most that you would pay out of pocket in a given calendar year. This is going to be for people who have significant health issues going on, a lot of expenses. For most people, they're not going to meet their out-of-pocket max. Honestly, a lot of people never even meet their deductible. So you need to look at what is right for you and what's important for you. But if you are going to meet your out-of-pocket max, you do have a lot of significant health issues. You can look on the right and see those figures. That represents how much potentially you would pay out of pocket in a given year. Please note that on the health savings plan, in the striped portion, they're subtracting $1,000 because that's how much UVA puts into the health savings account. So that kind of offsets some $1,000 of the cost. So I hope that's helpful to look at the premiums, deductible, and out-of-pocket max. This is the same slide, just with different coverage, just so that you can see a different level of coverage if you have employee plus children. We have all 4 of the scenarios online, so if you have employee plus family or employee plus spouse, you can see those online as well. So before I get into these next couple of slides, I just want to pause for a moment. I know we have a lot of participants and probably a lot of questions coming in. Deborah, are there any questions that we want to answer live at this point?
Yes, there's been several questions regarding having an FSA and an HSA. So specifically, if there's the employee who has an HSA with UVA and a spouse has an FSA with another employer, and so forth. So can you go a little bit more into detail regarding that?
Yeah, so if your spouse has a different employer and they potentially might have an FSA and you're thinking about having an HSA, then you need to talk to each other because you cannot have a full healthcare FSA and an HSA in the same calendar year if you're married. The IRS doesn't like that because they look at it as you can use those funds for your spouse. That's why it affects your spouse. So if you're gonna be in the high deductible plan and have an HSA, then your spouse is gonna have to agree not to have an FSA. Now, this is up to you and your tax advisor. We can't tell you what to do. But these are IRS regulations.
There's another question, a couple of questions about the increase on the health savings option compared to the overall increase to the other options. Do we have some information to help explain that?
If you want to give us your computing ID, we can definitely follow up with you later, but it's just, so our health plan is self-funded. And we have people who oversee the health plan and make sure that it remains viable and healthy. And when they reviewed the plan utilization and how to keep the plan viable, this is the decision they had to make to increase the premiums on the high deductible plan. They didn't want to take away any of the health savings contribution into your HSA. They wanted to keep that 1,000 or 1,500 going into your HSA, but in exchange, they had to raise the rates of that plan. If you want more information, let us know and we will connect you with our benefits administration. Anything else we can answer now?
No, thank you.
Okay, great. Well, we will move on. We will have some time at the end for questions as well, so keep them coming. So on this slide, we just want to remind people that we have an employee primary care clinic. This is for employees only who are on the UVA health plan. And it's really helpful if you don't have a primary care provider that you can go to on a, right away. Because sometimes I know that finding a primary care provider can take a while, especially if you're new to town and you're calling around seeing if who can accept new patients. So please know that this is available. And even if you have a primary care provider, sometimes you can't get in right away. So please know that this is an option for you to get immediate health care for primary care. In addition, this year we have a new benefit, which is pretty exciting. So we've had Teladoc before, which is just basically virtual medical care. But this year, we have a new benefit related to Teladoc, which is called Teladoc Virtual PCP, or Primary Care 360. And what that means is you can have your PCP through Teladoc. So if you don't have a PCP, you've had trouble finding one, you can enroll in this option, and you can get a primary care provider through Teladoc. So meaning your appointments with that provider are going to be virtual. But this provider is going to be your point of contact and someone you're going to maintain a relationship with. So they're going to get to know you over time. They're going to help coordinate your care. And of course, there are times where they're probably going to need to refer you to see someone in person or get a blood test or something like that. But they can coordinate your care. And so this is a very exciting new option that we are offering this year. And there are a lot of cost savings with this. So if you're on the UVA PPO plan or the choice plan, you're going to pay $0 for this virtual primary care visit. If you're on the health savings high deductible plan, you're going to pay $145 for your first visit and then $85 a visit until your deductible is met, and then you pay $0. We're hoping that this helps people to get the care that they need when they're having trouble finding a primary care provider, or they're having trouble, finding time to travel to a doctor. We hope it reduces the emergency room visits and helps you get the care you need before it becomes an emergency. You can scan that QR code to learn more and sign up for that plan. And of course, we have our regular teledoc, which is 24/7 care for non-emergency conditions. Like if you can't get into your provider and you don't need a primary care provider, you just need a one-off visit. You have a rash you want to ask about. You think you might be coming down with the flu. You're not sure what's going on. You can make a teledoc appointment for virtual care. In addition, Teladoc and these other platforms offer mental health resources, which is very, very important. We want you to prioritize this. So you can, of course, still make appointments with someone in person in terms of getting counseling. But if you prefer, or if it's easier for you, you can also make an appointment through one of these virtual platforms, Talkspace, Array at Home, or Teladoc. You can work with a counselor through one of these platforms, and you can maintain the same counselor. So it's not like you have to be bounced from one person to another, because I know that's important when you're getting mental health assistance. So please know that that's available and make use of that. I will note that these are not free. They're going to be subject to the deductible and coinsurance, just like it would be if you went to a counselor in person. Okay, we're going to move on to dental and vision. So for dental, things are very much the same as last year with one little exception. So we still have the basic and enhanced dental options. Both of them still cover preventative care at 100%, meaning you're going to get your 2 cleanings a year and your basic x-rays at no extra cost. If you have things like fillings or other services, you're going to meet a $50 deductible first. But so the reason that you might want to consider the enhanced versus the basic is, one, if you are interested in orthodontia care. So if you or a dependent are thinking about getting braces or Invisalign, then the enhanced is the only option that covers orthodontia. It pays 50% and you pay 50%, up to a lifetime max of $1,500. This is what's new from previous years. Previously, it was a $1,000 lifetime max. So this gives you another $500. So it's a $1,500 lifetime max. Once you meet that lifetime max, then that person can no longer get orthodontia care covered under the insurance. The other reason you might want to have enhanced versus basic is if you have a lot of major services planned or expected, because your basic option is going to cap out at $1,000 benefit for the year, and your enhanced is going to go up to $2,000 benefit for the year. So if you know you might be heading towards a new crown or something like that, then you might want to look at the enhanced option. For the major work, both of them are pretty similar. The basic, you pay 50%, enhanced, you pay 40%. But the main difference is that one caps out at $1,000 more than the other. The dental premiums have gone up slightly. You can see in parentheses the difference from last year, but still very affordable. Any questions on dental that we need to answer live before we move on to vision?
I'm not seeing any.
Okay, great. Dental is pretty straightforward, usually. And lastly, for vision, we have two options, but only one of them is actually vision insurance, and that is our Davis vision coverage. If you want a traditional vision insurance plan, it is Davis Vision. It's going to cover your annual eye exam, and it's going to give you an allowance towards lenses, towards glasses or towards contact lenses. You choose which one you want to apply that to. The great news is that the allowance is increasing from $130 to $150. So that is the good news. And if you are planning on getting new glasses or contacts and you're going to need that annual eye exam, then usually the Davis Vision coverage is worthwhile to be on in terms of how much it costs, which I'll show you in the next slide. It kind of depends if you have family coverage, if other people in the family are going to be able to use that or not. If you're someone who doesn't really use vision coverage very much, or you're just planning on sticking with the same eyeglasses that you have now, and you don't want new glasses, then you could consider, instead of Davis Vision, you could just use the Aetna discount program. Now, that's only going to be true if you are covered on the Aetna UVA health plan. But if you are, they do offer a discount on eye services and eye products. It is just a discount and it is not insurance. So just keep that in mind. You cannot use both of them in the same visit. So I just want to point that out, as we usually get that question. The premiums are on this slide, and you can see they've actually gone down a tiny bit. So we'll take all the good news that we can get. Again, very affordable. All right. We are going to move on to talk about flexible spending accounts. If you are not in the high deductible plan with an HSA, you still have the option to set aside money pre-tax for out-of-pocket medical expenses. And you do that through a healthcare FSA. So anyone who is not on the high deductible health plan is eligible for a full healthcare FSA. And you can put up to $2,500 in that for the year. You don't even have to be on the UVA health plan to have an FSA. So we get that question a lot as well. So what happens is you decide how much you think your out-of-pocket expenses are going to be, and then you set aside money pre-tax up to $2,500. And then that money comes out of your paycheck over the course of a year, spread out over 24 paychecks. However, the full balance is available upfront in January. So if you say, oh, I want to put $1,800 in, by mid-January, you're going to have access to that $1,800 upfront, even though you haven't put all of that money in yet through your paycheck. You will also get a card, and I forgot to mention for the HSA, this is true as well. You'll have like a debit card where you can swipe it at the point of service to pay for eligible health expenses, or you can get reimbursed after the fact. I do want to point out this is use or lose. So if you do not use what you set aside for the year, so again, using the example of $1,800, let's say you only use $1,000. If you don't use that other $800, it is going to disappear after the grace period. So you're going to forfeit it. So that's why you want to be a little bit cautious about what you put aside. We do give you a grace period into March 15th of the following year to use those extra dollars up. Okay. We have one other type of FSA, and that's a dependent care FSA. This is mainly for people who have children under the age of 13 and they have daycare expenses. It can also be used for elder care, so for adult dependents who are not capable of caring for themselves. So you can contribute up to $7,500 this year if you're filing jointly for the dependent care FSA. If you're filing singly, you can contribute up to $3,750. This is the IRS limit for this year. The funds are available upfront, just like the healthcare FSA. And just like the healthcare FSA, it is use or lose. So if you don't use all of that money that you put aside, you're going to forfeit those funds. And the other thing I want to point out about the FSA is you cannot change it mid-year unless you have a very particular qualified life event. Otherwise, whatever decision you make during open enrollment, you are going to have that for all of next year. So just put some thought into it in terms of what makes sense for you. Again, just to repeat, if you want an FSA for next year, you must go into your open enrollment event and elect it. Whether you have it this year or not, you need to go in and elect it for next year if you want it for next year. Otherwise, you will not have it. And just to remind you again, if your spouse has an FSA, don't have an HSA, and vice versa. So we're going to move on to talking a little bit more about saving for retirement. But Deborah, are there any questions about the health, dental, vision, or anything we've covered so far that I should address right now?
Just working through these, still a lot of questions about HSAs and FSAs. So maybe we just need to repeat that it's regarding the full FSA and HSA, not the limited FSA and dependent care FSA. Can we just?
Yeah, I didn't get, thank you. I didn't really go into the limited FSA just because it can be more confusing, but I will bring it up. So if you have an HSA and you are maxing it out and you want to set aside even more money pre-tax, you can open what's called a limited flexible spending account, which is different than a full spending account. And that limited FSA can only be used for dental and vision expenses. So it's very specific, and it doesn't, for a lot of people, it doesn't work that well, but it does work for people who are really trying to max out their pre-tax deductions, and they know they're going to be able to use that limited FSA for dental and vision, and they're going to use all those funds because it is use or lose. But if you have a full FSA, that's for people who are not on the high deductible plan. I hope that clarifies, but we can certainly follow up with anyone who wants to discuss more about the difference between the FSA and the HSA. And we also have a really great video on the website that explains exactly that. What is the difference between an FSA and an HSA? The main thing is the FSA does not roll over year to year. It's use or lose. The HSA does roll over to year, so you never lose that money if you're on the HSA. I do want to point out that if you're on the HSA plan now, the health savings plan now, and you're thinking about moving to the UVA PPO, you do not have to spend down your HSA. You can keep the funds in your HSA. There's no problem with that. There's no problem with moving to an FSA the next year. So the problem is contributing, not having it. I hope that was helpful and it didn't confuse you more, but certainly we can work one-on-one to help answer any specific questions. So feel free to write into Ask HR. We also have one-on-one open enrollment appointments. We'll be happy to meet with you. So we're going to move on to saving for retirement. Now, this is something that you can do at any time during the year, but we know that open enrollment is when people look at all of their benefits, and it's really the best time to talk to people because we have your attention. And so please, if you're not saving much for retirement in terms of beyond your core retirement plan, if you don't have a supplemental 403B and 457, I really urge you to look at that. Why? Because as we know, these are uncertain times, uncertain economy. There's just no way you can be over prepared for retirement, I don't think. Maybe there is, but for most of us, we're probably a little bit more underprepared. So setting aside more money for retirement is always good. Plus, there is a cash match option, which we're going to talk about in the next slide. Your savings compound over time. So if you start now, I guarantee you in 10 or 15 years, you're going to be really happy you made that decision today. And you have the option of saving money pre-tax, meaning reducing your taxable income now, or you can use a Roth option, which means you pay the taxes now, but your savings grow tax-free and you don't pay taxes then in retirement. So you have that option to do Roth or pre-tax or a combination of both. This is an example of how just $100 a month, $50 a paycheck if you're biweekly, could grow over just 10 years. And that's assuming a 7% growth rate, which is fairly modest. So just think about the fact that if you start now at 0, in 10 years, you could be at 17,000 plus. I guarantee you in 10 years, if you're going to be much happier if you have $17,000 than if you have 0, because you're still debating to whether to start or not. And this is the information on the cash match that I was talking about. So it kind of varies by which retirement plan you're in. If you're in the VRS hybrid plan, you have 2 potential cash matches. You can get a cash match by contributing up to 4% more to your hybrid plan and getting up to 2.5% cash match for that. And then once you max that out, you can then enroll in a 403B and get an additional $40 monthly cash match if you contribute at least $80 a month. So if you're in the VRS hybrid and you want to do that, but that's a little confusing to you or you don't know how, please reach out and we will send you instructions on how to do it. If you are in the optional retirement plan or one of the older VRS plan 1 or 2, or the older MCRP plan 1, you're going to get a $40 cash match if you contribute at least $80 a month into a 403B, meaning that we match 50% up to a maximum of $40 a month. If you're in the Med Center Retirement Plan 2, which is the current modern plan, you get a cash match of 50% up to a max of 2% of your salary. So if you contribute at least 4% to a 403B, you're going to get the max cash match of 2%. So I would say for those of you who are not getting the cash match, I would challenge yourself to at least get the max cash match. If you're already getting the max cash match, then maybe challenge yourself to just set aside more for your own future benefit. Of course, you know what works for you. And you can also meet with our Fidelity, TIAA, or VRS advisors, and they can help you to look more at your own financial picture. Another question we get a lot during open enrollment is about life insurance. And this, again, is something that you can actually change at any time during the year in terms of you can apply for extra optional life insurance at any time. However, you are going to need to provide what's called evidence of insurability, which means that you're going to answer health questions. And then the vendor will determine whether they want to cover you for that extra additional optional life. However, there is one very specific circumstance that is related to open enrollment. And that is for people who are in the optional retirement plan or the Med Center retirement plan only. And those participants have a company called The Standard for their life insurance vendor. So what the circumstance is if you're in one of those plans and you already have optional life at 1 or 2 times your salary, you can increase that by 1 increment without providing health information. So in other words, you can go up by 1 increment with it being a guaranteed issue. So again, you have to already have at least 1 or 2 times your salary in order to go up 1 more level. It cannot exceed 3 times your salary or a max of 500,000. And if you are on one of those plans and you have 25,000 in spousal life, you can increase that by 1 increment up to 50,000 without having your spouse answer any medical questions. I hope that is clear and makes sense, but let us know if you have questions. Again, you can request additional life at any time during the year by providing health information. So for everyone, regardless of which plan you're in, please review your beneficiaries. Make sure that you have beneficiaries named and that they are up to date. This is really important for both your life insurance and for your retirement accounts. If you are in VRS, you can update all of your beneficiaries for life and retirement right online through the My VRS platform. So log into My VRS and you can change or you can check all of your beneficiaries there. If you are in the optional retirement plan or Med Center retirement plan, you can update your life insurance benefits through Workday. You can actually do it through the open enrollment task, for example, or you can do it at any time outside of open enrollment as well. For your retirement vendors, if you're with Fidelity or TIAA, you're going to want to log in to that platform through that vendor in order to update those beneficiaries. So we hope that you will put that on your to-do list. It's not something most people like to talk about, but if something happens, it does make it a lot harder for the people we leave behind if we don't name beneficiaries. We have Who's Well, just again next year, as in previous years, you can earn up to $500 for doing very easy things to improve your health. So keep in mind that if you haven't maxed out your earnings for this year, the deadline is November 30th to earn and record your activities. And then for next year, it's going to start in February, where you can start earning rewards again. You can earn cash rewards if you are enrolled in a UVA health plan. Your spouse can also earn rewards if they are on your UVA health plan. So lastly, I'm just gonna reiterate some action items just to make sure that we've clarified all of this for you. If you want an FSA for next year, you need to go into your open enrollment and elect it, whether that's a full healthcare FSA, a limited FSA, or a dependent care FSA. If you are adding new dependents, or if you are adding existing dependents onto a new plan, you must upload required documentation. If you scan this QR code, it will take you right to our list of what that required documentation is. And when you make your benefits elections in Workday, we say this every year, but people just, you get in a rush and you think you don't need to do it, but please save your benefits election task as a PDF or print it out after you submit it. So when you go in, make sure that you review and sign, click the I accept, click submit, make sure it has gone, and then a message will pop up saying, do you want to save this or print this? And yes, you do. Not only do you want to save it or print it, but you want to look at it before you put it away and make sure that what you intended to do is actually what is reflected on that document. And I say that just because, as you know, there's only this 2 weeks per year where you can make these kind of changes without a qualifying life event. If you are going to be new to the HSA, make sure you watch for communications from Fidelity about opening your account in case they need any extra information from you. Not everyone will have to do something, but some people will need to provide additional information. If it's not open and ready for funding within 90 days, you will forfeit the employer contribution. And we really hope that no one does that this year. And lastly, if you have an FSA this year, a full healthcare FSA, and you want to switch to the health savings plan with an HSA, you need to spend down your FSA to absolute zero by the end of this calendar year. Otherwise, we cannot open your HSA until April. And that has to do with IRS rules. Again, they don't like any overlap between FSA and HSA. And the FSA has a grace period. And so you can't have money available during that grace period and also have an HSA open. So that is why. However, if you're going the opposite way and you're moving from the HSA to an FSA, there are no requirements to spend down your HSA. You can keep those funds. Lastly, once you do your open enrollment, you're going to get a survey. And please take a few minutes to do that survey because it gives us good feedback that we can review. And every year we try to make improvements to our open enrollment to make it easier and more accessible for everyone. Thank you so much for attending today. As always, contact askhr@virginia.edu or give us a call with any questions. I do want to do a little shout out here for our walk-in days coming up. October 6, 9, 13. We are going to be available 8 to 5 at Old Ivy Hall at 2420 Old Ivy Road. Come up to the 3rd floor and you will be directed to where we will be to help answer your questions. If you're at the Medical Center, October 15th, 8 to 5, we will be in Dining Conference Room 3. So with that, do we have some questions that we can answer live? And for those of you who are attending, if you want to drop off, thank you so much for being here. We really appreciate it. But if you want to stay on with any final questions, we'll stay on for just a little bit.
So still working through, there's a lot of HSA and FSA questions still. So
Okay.
I'm just going to kind of try to get through these.
Do you want to read any out loud? Okay.
Oh, I'm sorry.
Do you want to read any of them out loud and we can answer them?
Sure. So can you transfer money from HSA to FSA? The answer is no. There is, can we change the amount of the HSA throughout the year? The answer is yes, that can be changed at any time.
Effective the 1st of the next month. So you can change it on a monthly basis.
Correct. So a lot of questions about if the person has a health savings option now with HSA and they switch to the UVA PPO plan, what happens to those HSA funds? And basically you can continue to use those for eligible expenses. So a lot of questions regarding that.
Yeah, you're never going to lose those HSA funds. That is like a bank account. Those funds are yours to keep. You don't need to feel pressured to use it right away. You can continue to use them over time, regardless of whether you move to a new plan.
There's also a question about can the HSA funds be used for family members that are not on the UVA health plan? So that is, you can use them for people that are on your tax return, correct?
Yes, you can use them for family members, like children that you claim as a dependent on your tax return, or you can also use for your spouse.
One of the questions is how does the person know if they're receiving the UVA cash match? So if you are participating in the 403B and or the 457, you can go into Workday and you'll see the 401A, which is the UVA cash match. If you want to determine if you're maximizing that, you can reach out to Ask HR. We could take a look at that for you.
And the dollar amount will show up on your paycheck. The dollar amount of the match doesn't show up on the benefits screen, but when you look at your paycheck, it'll be under employer contributions.
There's questions about Medicare participation in HSA. So if you are under Medicare Part A, you aren't able to participate in the HSA. If your spouse is on Medicare, but you are not, you can participate in the HSA. So your spouse's Medicare participation doesn't impact that. It's yours. I'm still working through these questions. Can we just stay active as we work through these? Okay. One of the questions, if you switch from basic to PPO this year, can you switch back to basic in 2027 and recontribute to your HSA? The answer is yes, you can do that. One of the questions might be easier for me to just read them out loud instead of typing answers. Is life insurance portable? Yes. So if your coverage ends due to, for example, separation of employment, you can convert that to an individual policy. And for some employees, you can port the coverage. And there's a little bit of nuance to that. I won't get in that specific here, but there are options to port or convert depending on your specific situation. There was also a question about the AI bot. So last year we offered kind of a
Oh, yes,
chat.
Alex.
Yeah, Ask Alex, that's right. And so that is not available this year. So I did have a few people ask about that. Um, they remembered that from last year. A question about beneficiaries being overseas. That's not an issue. You can name whomever you wish. They don't have to reside in the United States. There's a question about changing retirement account contributions. Is it in Workday or the vendor? If you are contributing to the 403B, you do that through Workday. If you're contributing to the 457, whether it's through the VRS hybrid plan or the Commonwealth of Virginia 457, that's going to go through Voya. Somebody asked about the Who's Well rewards. Are they taxable? Yes, they are taxable. They're going to be on your quarterly paycheck and they are subject to taxes. Does UVA offer accidental death and dismemberment insurance? The answer is yes. That's part of your basic coverage. And if you purchase optional coverage, that will also be included automatically in that. Oh, okay. So the person asked whether or not Who's Well can become non-taxable. I don't know that that's permissible. I think due to the type of reward it is that it is taxable. Maybe for this person, if you can maybe just reach out to askhr@virginia.edu and we can take a look at that. I don't think it's can be non-taxable, but we'd need to look into that. One of the questions is, can new employees sign up before open enrollment? Absolutely. So if you have a new hire benefit enrollment event, you definitely want to make sure that you complete that. That's going to be for your coverage through the end of the year, and then you'll receive the open enrollment event. And that would apply to new hires through a certain date. So after you're hired after a certain period, you won't receive open enrollment, but for new hires as of today, yes.
I am just typing answers as you're answering, so
Thank you.
between the two of us.
Thank you very much. Lots of great questions and they're coming in very fast. So I appreciate you all asking and we're working through them as quickly as we can. So thank you. Appreciate that. Somebody asked about setting up a one-on-one counseling appointment. Just send an email to askhr@virginia.edu, and then we can get you scheduled for a one-on-one session. A person is asking about, oh, thank you, Kelsey. So Kelsey put the email address in the chat. One of the questions is, will I have the option to remove my child from health insurance if she is covered by her own employer? Yes, you can remove your child from your coverage if that child now has coverage through their own employer. Just you have to be mindful of timing. So you do have to request that change within 60 days of the new coverage. So if it's been more than 60 days since that person gained the new coverage, then you're outside of that window during which to make that change. But otherwise, yes, you can remove your child due to other coverage. Vision, the question is, does vision reset at the first of the year? And yes, it's based on a calendar year.
Someone is asking about the maximum they contribute to the HSA. So it depends on whether you have employee-only coverage or employee plus dependents. So those amounts are on our website. And then you subtract the employer contribution from that total. If you need some more help, let us know.
There's a follow-up question to that qualified life event. So what happens if I'm outside the window? Then you would not be able to make that change to that qualifying life event, but you can make the request during open enrollment. So you could request the child be removed effective December 31st due to open enrollment. So
I'm going to pause for a moment here. Kelsey, since we're at time, is there a way that we can perhaps save these questions and reach out to these folks? Or I guess we cannot if we don't have their computing ID. Oh, Kelsey is not responding.
I'm looking into it right now. If you'll give me just a
Okay, thank
moment
you.
and I will see what I can do.
Okay, but in the meantime, we're just going to keep typing and answering and
yeah, going as fast
we
as
didn't
we can.
expect this many questions.
There's a question that came through a little earlier that was very specific about preventive care visits. So for that, if that individual is still on the call, let me see. Okay, so I don't think the person is still in the webinar, so my apologies. That was a very specific thing. We're working on getting you answers, but again, you can also reach out to askhr@virginia.edu if it's very specific, and we can take a look at that for you.
Someone's asking about the dependent care FSA. Maybe I wasn't clear on that. I think maybe I did say that wrong, Wesley. I'm so sorry. The dependent care FSA, those funds are not available up front. They're available as you contribute. So the funds do have to be in the account before you can use them. Sorry if I misspoke on that.
Okay, so we've discovered that we're not able to respond to questions if we don't have a computing ID, at least through the Q&A. So what you might want to do is, if we haven't yet answered your question at this point, go ahead and send an email to askhr at virginia.edu so that we can follow up with you. We appreciate all of the questions. Just doesn't look like we're going to be able to get to all of them with the session. So thank you again, and send an email to askhr@virginia.edu.
We're going to go ahead and get ready to stop our recording. We'll again encourage you to email any additional questions to our Ask HR email that is in the chat. And thank you again so much for attending our session today.